Hello, everyone. Happy New Year and welcome to the first weekly roundup for the year. Today, we will explore 10 key themes we believe could shape the year ahead. Hello, Ben.
Hi, Eva. Welcome to 2025.
Yay. How's 2025 been so far?
Yeah, good start so far. No issues. Lots still going on in the world, but so far so good.
Okay. Before I let you do your thing,
Sure.
for those that are joining us for the first time, my name is Eva Omebisi, and I'm a wealth management associate with Hart Investment Group. And this is Ben Hart, his senior wealth advisor and portfolio manager at Hart Investment Group with National Bank Financial. Nice to meet you. Thank you for joining us. I'm
Awesome.
excited to hear what you have in store for us today.
Yes.
So I'm going to stop talking and just hand it over
All
to you
right.
to take us away.
All right. Thanks, Eva. Thanks for the intro. Thanks for putting this all together. And gonna do my best to get through as much as I can around what happened last year and what we expect to happen this year. So I appreciate everyone taking the time. So it is, we're recording this on January 16th, 1 o'clock. So anything that happens after this, certainly won't comment on. But anything that's happened prior to that, provide my comments, thoughts around what happened last year, what we see happening in the future, and I'll just take you into the presentation now. All right, super. So January 16th, as we noted, and here we go. Just a quick look at the disclaimer before we jump into the presentation to give you an update. Lots of stuff on here, but certainly the opinions expressed do not necessarily reflect those of NBF, which is National Bank Financial. So any questions, please consult your investment advisor. So without further ado, let's jump into that. So as Eva said off the top, there's a number of key themes that I think not only have been asked to me repeatedly throughout the year, but also what's come from the research and information I have. So these are really the 10 key points, and I'm going to hit on each one here as we go and do my best to explain what and why. But lots of questions from clients about inflation. Certainly, we've seen inflation across the board. I went the last 2 weeks, I've been trying to get cocoa from the grocery store. Every time I go there, it's sold out. Cocoa is at an all-time high. So just to give you context around why people are worried about inflation, because it seems to be happening everywhere. What happens to interest rates? Well, certainly the two of those together play a material role. Interest rates and inflation are maybe connected, maybe correlated. I'm not sure, but certainly connected. And so we'll talk about our view around what's going to happen with interest rates. Um, I commented on the 1960s redo. So for those that have been following along with this, the world's really been thinking about a couple of narratives. One, are we in the 20s and or are we in the 70s, potentially in the late 80s, from an inflation perspective? And so there's not a lot of context that we've been through in history that's as close to what we have now, where we have a global economy slowing, we have inflation a little bit persistent, and then we have the central bank, particularly the U.S. central bank, staying quite tight with their financial conditions. So very similar setup to the mid 60s, actually 1966, where we had the central bank tighten monetary policy quite quickly and then stay there for a period of time. So I thought that that was an interesting take on the world. So we'll look at that a little bit more. Does diversification matter? I love to comment on this. And, I started my career in 2000, which was the height of the tech boom. And so that was a similar period where this question continued to materialize: does diversification matter? And where we had a time where some of the big tech companies, JDS, Nortel, those were the big drivers at one point, and Nokia made up 40% of the Finnish stock exchange. We have a similar setup today where we have the Mag 7, which are the big tech companies. That would be Amazon, Meta, Nvidia, those names that are really controlling and driving the index right now. And if you strip away those big names, then the actual rate of return of the S&P was fairly muted last year. And so, really concentrated market right now. So getting a lot of questions about diversification. So I'll comment on that. Will the U.S. continue to lead the way? again, I think a great question. The US has really been dominant in the software space in the world. And so, as we've focused on a lot of attention towards AI and so on and so forth, software has really led the way. But the next wave of what's likely needed to continue the pace of growth would be hardware necessarily. So if we look at hardware, hardware has been made in other parts of the world, Asia. Certainly, that's where they've been leading the way. So that's something to think about when you think of the U.S. exceptionalism that we've gone through here. Could China and Europe surprise to the upside? This is certainly anyone that wants to talk about this and knows the intricacies of Europe and China. This is a pretty heated discussion and debate, really contrarian when you want to talk to individuals because the European economy is contracting. Germany is a bit of a mess now, and France doesn't have a leader. So certainly that would be a surprise. So to the upside, in China, China's gone through a really difficult real estate period here. And so as we look at the Chinese economy, we're having the Chinese 10-year at an all-time low. They are also having some challenges with their overnight rate spiking the last couple of days. And so that would certainly be a counter view as well. Might this be the year to own bonds only? So in bonds case, it really matters your starting point. And so as we start to approach the 5% levels for bonds on high quality government and high quality corporates, this starts to play a material role. And often people ask me, why is that? And so some of the big players in the investment space are the institutions, the pensions, and while they have successful track records from a rate of return perspective, the actuaries who provide the projections for the companies, the pensions, actually play a material role for asset allocation. And as you see rate of returns or yields at the 5 or 6% range, you start to see these institutions start to look at allocating their capital there because it provides them a bit more certainty that they can meet their financial objectives. And so it does matter as we start to approach these levels, and bonds could play a material role over the next 12 to 24 months. Do unloved markets, stocks, and economies turn into 2025 darlings? So every year, obviously, I always look at this. I want to see what were the best performers and what were the worst performers. And if you followed along, you'll maybe note that the S&P did quite well, not the top performer. Top performing ETF in the world which is an exchange traded fund that tracks an index, so you can buy this, was Argentina in US dollars. So the Argentinian index was number one, and Israel was number two. If you look at the opposite end of that spectrum, you'd have Brazil in the bottom and Mexico second from the bottom from an ETF perspective. And so if we look at those particular markets, you can think about why and how that happened. I look at Brazil and Mexico. Brazil certainly is an economy that it thrives when energy is doing well, and they have also some big consumption there. So that's an interesting one that I'd be paying attention to. I think we've entered a period where oil's come down, and we're probably going to be a little bit more in a range-bound market, so the opportunity there. Mexico, I think, is primarily driven off what has happened with leadership change that's coming in the U.S. And so, as we know, President Trump's been talking a lot about tariffs, and we'll talk about tariffs today. I think the Mexican market has been trading down with the fear of what could potentially happen there. So there's some great companies in Mexico, like America Mobile or Cemex, some interesting businesses that are worth paying attention to. And what's in store in Canada for 2025? Well, when I started writing this presentation, seemed like we were going to have a bit of a meandering year. Rates will continue to come down, but then we had a surprise announcement where Prime Minister Trudeau is stepping down. And so we're going to have an election at some point late spring, early summer. And so that could play a major impact for what happens in Canada. So we'll elaborate on that. And then the last point, which isn't necessarily in agreement across the board, but does the technology lead to disinflation or deflation? And so I think this is an interesting point to consider and think about. I think on a long tail perspective, if you look back and you looked at when you bought your first computer or laptop or flat screen TV, what you paid for them versus what you pay for them, what you pay today, certainly some technology is super disinflationary or deflationary. So this will be something we'll try to cover today as well. So as I hit through these, there's many things to go through. I'll try to hit on a few of the things I think that are most topical that people are thinking about and paying attention to. Is the one thing that gets a lot of press and maybe people like to put on the headlines is the debt ceiling that the U.S. likes to come into contact with every once in a while. And so they have this self-imposed ceiling every time they get to that level, even though it gets moved every time. But every time we get more to that level, there starts to be a bit of maybe a media frenzy, news headlines around what's going to happen when we get to the debt ceiling. So certainly I felt the same way probably close to 10 years ago, 2014, 2015, when Bernanke first had to talk about this, and other of the treasurers and central banks had to talk about this debt ceiling. Now it is much more functioning. And what happens is if we reach a debt ceiling and there's no agreement, what happens is there's another function within the government called the Treasury. And the Treasury has what's called the Treasury TGA, which is a Treasury General Account. And so as we reach the debt ceiling, the government no longer wants to pay anybody. Treasury comes down, they pull down from the general account and continue to pay their bills and keep the government functioning. So what historically was a time of maybe concern, now as we think about it, what happens is TGA pulled money into the economy, and that actually provides a liquidity function into the system. So that's a liquidity boost. So we've gone through a period where we've had this contraction where U.S. government started to talk about maybe fiscal restraint, and maybe we're not going to cut rates as quickly as we thought. All this jargon and information that U.S. central bank's been talking about has really tightened financial conditions. And so we've seen bond yields move materially since the presidential elections passed. And so the markets actually tightened quite dramatically. And the likelihood from this point, at least for the next quarter, is we start to get we get strengthening financial conditions or softening financial conditions, which is a positive for markets and bonds. So that's the first point. I'd say the other things to think about that I like to have a look at here is just emerging markets and economies. We've had a super, super strong US dollar relative to pretty much every asset, pretty much every currency in the world. And what emerging markets like is the opposite of that. And so what's likely to happen from here, I think, is a weakening US dollar, at least over the near term. And so that's something I'd like to think about. Energy is always something to be concerned about. So the energy complex is something we continue to watch and plays a material role in what happens in Canada. And then consumer sentiment is also very important. And why consumer sentiment is important, as you probably know, the consumer makes up a big percentage of GDP in the United States. Right now, it's something in the neighborhood of 70% of GDP is consumption. And then you're looking at about another 20% in government spending, and then maybe another 10% plus or minus in the residuals, exports, imports, and so on and so forth. But a big chunk of what happens in the U.S. Is driven by consumption. So as we went through an extremely unstable political period over the past 12 months, I think I'd like to just comment on a few of these and really think back 12 months, and all these things that happened played a role in the world, but really had a non-effect on the markets and the economy. So I thought that was quite interesting. So U.S. presidential election, President Trump wins again. It was a very interesting contested election this year. A lot of changes, lots of nuances within it. Ukraine and Russia continues to move forward. What President Trump does next week when he gets into power will certainly be interesting. Takes over Monday, and as you probably remember, when he got in last time, he signed all these executive orders. So I think this time next week we'll probably have an interesting idea as to what's going to happen from here. Israel, Palestine, Iran, Lebanon. So as you probably all saw, Lebanon and Israel had a ceasefire put in place, and Palestine and Israel looks like are in the process of putting another ceasefire in place. So Israel, Iran will continue to be something important to watch for what happens in the geopolitical realm. Syria, brothers that follow this, we had Assad effectively squeezed out, living in Russia right now, but Russia is trying to put him back into place there. So that's continuing to cause some upheaval in the world. Germany's government has fallen apart, to my point before. The economy is contracting, a number of other things playing a part there. The South Korea, we saw that martial law was put in. They've taken him out. France's government falls, so effectively Macron is taking in and taking over and stepped in. They need to put something in place. Romania's presidential election was annulled. So all these things happened in the last 12 months, and you may look at it and say, well, it didn't, there's nothing material that happened in the rest of the world. But these are giant events that have happened. And this could have happened over 10 years, but this happened in the last 12 months. And really, the market didn't blink an eye. So that's interesting as well, just as we think of the potential events that can happen from here. So just a quick look back at the markets. And so for those that follow it closely every day, I'm sure they know how things played out. I had a conversation with a prospect recently, and they told me their return numbers from where they're working with, and wasn't very good. So I look at it and I go, well, US stocks went up, Canadian stocks went up, gold went up, US dollar went up, emerging markets went up, international markets went up. The only sectors that I'd say were a bit mixed were commodities, volatile throughout the year, generally trended down, so there's some opportunities there. And bonds were down across the board. But more than anything, they were extremely volatile. And so if you're interested, and sometimes people follow the volatility in the stock market, and that's the VIX that tracks the volatility of the stock market. In the bond world, it's called the MOVE Index, MOVE. That shows you the volatility in the bond market. It's been extremely high this year. And so I don't see that changing anytime soon. Certainly to start the year here, we've seen more volatility around what's going on in bonds. And so we'll continue to watch that. But overall, it was a great year, depending on how much risk you took. Further up the risk and concentrated growth scale did better, but generally balanced portfolios did well, and it was another good year in portfolios. So certainly happy with that. So a couple of key, I'd say, opportunities and points that I'd like to point out. Again, there's a lot of writing on this and a lot of different things you can look at. And this video will be recorded. You can watch back to see if there's anything you have any questions for me on it. But I think that some of the big picture trends continue is AI and high tech investments. So I do think AI can play a material role in the world. Is it going to move at its same pace? It's probably going to start to accelerate at some point. But I think there's this overarching fear about the number of jobs it's going to take. And I guess I think about it from a perspective in efficiencies. Where's the opportunities? Where's the efficiencies we can do? What can we use? How can we use it? I don't know if you have had any time to use any of the facilities, but Google has integrated Gemini into their search engine, and ChatGPT, which is the kind of I'd say the leader in this space from a, we'll say, consumer-based or user-based engine. So there's plenty of opportunities. The businesses that are working with them, tagging on with them, co-pilots, another. So the opportunity set there, I think, can provide efficiencies within a lot of areas and businesses. And I do think that's actually disinflationary or deflationary. So I think this will play a role. But do I think it's going to take every job out there and it's going to replace everyone? By no means. I think it provides you the ability to be more efficient and use it to your expertise. The other area in that space, I'd say, is robotics. So there's a lot of companies that are starting to use robots, and a lot already do. And if you look at South Korea, for example, something in the neighborhood of 20% of their workforce is robots. So They use it on the manufacturing lines. And so I think robotics will play a major role. There's not a ton of great publicly traded companies in that space right now, but that I think will be an area to pay attention to as we move forward. So I'd say let's hit to point four. I know I've commented a little bit on fixed income resilience, so attractive yields in corporate bonds. So as I mentioned, yields have crept back up since they touched their lows in November, just prior to the election. So I think that's interesting as well. You know, the starting point really matters. Anytime bond yields start to approach the levels they are like this, quite positive 12, 24 months, 36 months returns. So certainly important and interesting to think about. One of my favorite ones, which is number 8, which I'll hit on that one, is value investing potential. And so as we look at the massive divergence we have right now between value versus growth, it's as big as I can remember. And if you look at the NASDAQ versus some of the other indices, it's off the charts in standard deviations, how far the growth areas have performed relative to value. And so as you start to think of where potential opportunities are, I certainly don't think that the tech area and the tech growth area is done yet, but we're starting to reach those levels that I think are important to pay attention to. So just another key point on this here is just that level of US stocks outperforming. So 8 of the last 10 years, the S&P has outperformed the rest of the world. And so as you start to get this confirmation bias, you start to say, okay, well, this will continue to happen in perpetuity. And so if you stretch this back, I know this is the 1990s, so it doesn't take you back all the way into the 60s, 70s, 80s, which you could, and we'd get similar types of areas. But as you think about this period, and to the late 90s where we had US outperformance by material amount, we went through a decade of underperformance for the US. And so I'm not saying it's exactly going to play out this way again, but it's food for thought when you're thinking about asset allocation opportunities, readjusting portfolios. If you've done well and made good returns from some of your holdings, it may make sense to think about your rebalancing your assets and your portfolio. So 8 to 10 years, S&P outperformed the rest of the world. I don't think that's likely to continue, and something that we should continue to pay attention to. This is a great chart that was put out by our CIO office. So as we get into the end of the year here, we just look about the last 2 years. And so, as I mentioned at the top, been a pretty good performing period over the last couple of years. And so, as we look ahead, I think it's more important than ever to think about what you want to own and why you want to own it. And so, if we look at returns over the past 2 years for these different asset classes, that just gives you a feel for how investments have returned through that period. Certainly, it's a great look at what return profiles look like. So just a few comments, I guess, around tariffs and trade and so on and so forth. I do think it's important to think about this. And so I get questions about it all the time. What's the likely outcome? We have President Trump talking about 25% tariffs on imposed against Canada and many other places in the world. And this was a great piece that our economics team put out this week, just talking about the potential risk to our GDP if the 25% tariffs are put in place. And so a couple of other recessions, or we'll say GDP contractions that happened in Canada, just to give you a gauge of what could potentially happen. In 2020 was an anomaly. So if we look at the other periods of time where we've had GDP contract materially, so the research says that we could see a -6% GDP contraction if they proceed with a 25% tariffs. I think the probabilities of this are quite low, based on what is likely to come. When President Trump was in last time, there was less tariffs than are presently on today. So I think this is a lot of talk and bluster. But this is something to take into account when you think about asset allocation. If you're concerned that this is a potential risk that could have an impact on you, as yields as I say, have started to be more attractive in the bond area, maybe you put and take some shelter there if you're concerned about this playing out this way. But it's something to think about and take into account when you're thinking about your risk levels. So as we look at, I think, a potential opportunity, and so one of the things that was put into place in a number of years ago as we set up our free trade agreements with the U.S. and Mexico. There's a really low barrier to trade in North America, but interprovincially, it's very difficult. And so if the world continues to think about the protectionism that continues to happen, maybe this is an opportunity in the Canadian market to say how do the provinces figure out a way to work together? And so as I showed you on the previous slide of potential risk to GDP, maybe this is a potential opportunity as well for the provinces to start to take down some of their barriers and present some opportunities there. So as we think through, we're going to have certainly a new leader in Canada at some point this year. We think some of the potentially low-hanging fruit and or opportunities are is looking at how the provinces and Canada can work better together, more efficiently, um, better trade, and hopefully do something positive for the business sector in the Canadian market if the U.S. government decides to move forward on tariffs and trade. So this is probably the most prominent question I get on a daily basis, just what's going on with interest rates. And so people certainly care about this because it has an impact on your everyday. The Canadian market is built on a material amount of your wealth in real estate. And so a big chunk of real estate in Canada is in variable rate mortgages. And so variable rate mortgages are based off of the overnight rate. And so the overnight rate in Canada right now is 3.25%. And so for roughly speaking, bank prime is that plus two. So when you go to your bank, prime rate is around 5.25 plus or minus, depending on what bank you deal with on a daily basis. And so a lot of questions that I get from homeowners and from clients and from clients' kids is where are interest rates going? And so as we started this year, this was closer to 100% probability of a cut happening on the 29th. But now, as we've had some changes to a number of things in Canada, maybe a little bit of inflation, a little bit of employment, maybe a little bit more thinking about let's see what happens with President Trump getting in next week. This has gone more to starting to lean towards a probability of a hold at this point. And really, I think it's the view around the market's starting to price in anyways, the view that the Bank of Canada may hold back so they have a bit more flexibility in their March meeting because February there's not a meeting. So maybe gives them a little bit more flexibility to say, okay, maybe President Trump has imposed more than we anticipated and we'll have the ability to go 50 basis points if we want to in March. So that's been an interesting change of events. And as I commented on the Federal Reserve, which is the U.S. central bank, we're looking at a 97% chance of a hold. So it certainly wasn't this way 6, 8 weeks ago, but that's what the market started to price in. So, it's important to think about what is happening today, what the market's done, what it's thinking about, and what are the probabilities from here. And so the market has already tightened based on their comments. And so the likelihood of the next step is the other. And so if you look at the forward curve on interest rates, people are starting to, or the market's starting to price in anyways, that there's even a possibility of a rate hike in the US this year. I think that probability is extremely low, but that's what the forward market's saying. And so as we start to move into the next phase of this, a surprise inflation print, a surprise employment number, a surprise GDP number, all these things play a major part for what's going to happen. So now we've gone so far where financial conditions have tightened again. Likelihood of any of those surprises on those three metrics that I mentioned start to shift things in another direction. And the last comment just around European Central Bank. And so as we know, Europe's overnight rate's at 3% right now. We're looking at a 90% chance of a cut on the 30th, the Thursday. I'd say that continues to be the case as you look at the European markets are in a recession or around a recession, and they're having some difficulties in their major economies like France and Germany. And so what the stock market's doing in that area, it's also already telling you that because you get a number of companies that are trading at or close to their 52-week lows are reflecting already that we've seen a contraction in those markets. And so potentially there's some opportunities to think about it. And if you're a Bank of Canada central bank watcher, then certainly put these on your calendar here. These are the bank's meetings coming up, and certainly be important to think about. First quarter of the year is always important. And as we get into the Prime Minister changes in Canada, these period here, this kind of April to June area will be interesting because that's likely when we'll see the elections, federal elections start to come in. So great. Lots of people want to know where rates are going. And so our economics team does a great job with their forecasting. And I think this is a great simple chart just to think about really anything to do with their thoughts and views around inflation and or interest rates. And so when I talk to individuals looking at buying houses, this is a great chart to look at as well. So if you look at here where the overnight rate is, as I said, 3.25. Q1, here was where our expectation, and so that's 0.5% lower. So let's see, that's where we think. And then Q2, 2.5, so it's 75 basis points lower. And then Q3 and then Q4, excuse me, we think we stop cutting rates around Q3. So that's 100 basis points or 1% lower on the overnight rate. So this is in line with what we think is going to happen from that perspective. And so that number below is certainly the prime rate, as I say. So as you think about variable rate mortgages, that's what that is. The other thing when you think about is if you have cash sitting on the sidelines and you want to decide, should I buy a short-term bond or a short-term GIC or anything like that, this gives you some context to say, okay, the rate today, well, isn't as good as it was 12 months ago, but likely going to be better than where it will be 12 months from now. So maybe I start to think about maybe locking some of that into place. The other area you want to think about is not only from mortgages, but from a bond perspective, is the fixed rates at this point. So as you may or may not know, that mortgages in Canada, a majority of mortgages in Canada are 5 years and below. And so if you're looking at fixed mortgages, the 2 year at, we'll say 2.65 plus 2, gives you an idea of where the 2 year is and where we think it'll go. And same with the 5 year, where it is today versus where we think it'll go. Same applies to bonds. So if you're looking at owning and you have something, so you have a 5 year bond, if you're buying it at this level, or say at a 3%, you know that you're locking it in at this point, and maybe 6, 9 months from now, you're going to get a capital appreciation because yields have gone down, and that's an opportunity to consider. As you stretch out the curve in that regard, same thing applies there. So if you want to think the longer duration, the more potential swings you have in the bond market. But if you think the levels are at a reasonable point and you think it's going to here, that's a big potential capital gain protection opportunity if you're worried about some of the tariffs that could potentially come into place. And the final one just on here would be for CAD USD. This plays a part when I'm thinking about asset allocation, how much US dollar exposure, how much to have that way. But certainly I also have the question from the snowbirds is, should I buy my US dollars now or should I wait? And so if you look at the view and forecast, we certainly think that the Canadian dollar is going to appreciate versus the US over the next 12 months. And so that's something to think about from that perspective. So as we comment and continue to go through here, the Canadian Central Bank, as you know, is 1.25% below the US Central Bank. And so we're seeing a pretty big gap there. As we start to approach 1.5 to 2%, historically, that's when we got into a period of currency crisis. And so I do think that's part of the other reason why we think the Canadian Central Bank may be starting to think about what we should do at this point. So just the comparison, as I mentioned off the top here, was are we starting to enter a period between the 60s versus today? And so it's interesting to think about we're in a similar period where Kennedy and Johnson had similar pivots around what to do at this point. We're starting to see productivity as key driver, same thing, very similar. What happens from this point? Global geopolitical risk, US-China rivalry. I mean, these are very similar events that they faced in the 60s. The market sentiment, again, very similar. We had technology advancements going through that period as well, very similar to what's going on with AI and tech right now. And why do I say this? I think we think about what happened to the markets then over that period in the late 60s, early 70s, and start to think about, are we going to shift similarly? Is this something that we need to think about what we have in portfolios? So the key point is yes, a very similar setup and gives you at least a gauge to think about what and where we go from here. Just as I go and move in to talk about what I think is likely to happen going forward from here, just want to give a quick comment just around, as I mentioned off the top. Um, US stocks were up. Most things were up through this period. So the questions that I gave you at the top is what is likely to happen to inflation? Well, we think inflation probably moderates at this point. We've seen a couple of bouts of inflation pickup, but is a 12-month rolling number. And so one of the things that I think I've had to learn over my career is just to think about it that way. If inflation goes from 2.1 to 2.2, that looks like we got a big acceleration in inflation. It doesn't have to go from 2.1 to 4. We just need a small incremental increase, and that starts to stoke some fear into the markets that inflation is going to run away from us. So I don't think that's the case. I think inflation continues to come down, and for a number of reasons, with technology being one of them. But we also see the economy starting to struggle in both Canada and the US. And so I do think inflation comes down here. With that view in tandem, I think interest rates continue to come down as well. And so the market has pushed so far the other way since November, particularly in the US, where effectively they're saying they don't think interest rates are going to come down anymore. My view is they're going to continue to come down, and our view is that they're going to continue to come down based on the fact that the economy is contracting and employment is starting to tick up and inflation is coming down as well. So those are a couple of points. And just about the markets and the economy. Had a good year last year, had a good year the year before as well. Now it's time to start thinking about what's in front of us. So a few positive bright lights, and thinking a bit more forward is our Chief Investment Office team talked a little bit about PMI, and this is Purchaser Managers Index. I think it's important. PMI is one reasonable gauge to think about what's coming ahead of us. And so if we can project out to what likely happens from this path forward, is we think that the PMI starts to reaccelerate. So this is a positive signal. If we get PMI reaccelerating, we get the Treasury General Account liquidating. This is providing a little bit more positive liquidity in the system. We've actually seen consumer sentiment shift quite positively in the past couple of weeks as well. So there's certainly some positive areas of light that we think about for what's going to happen in the markets and economy. Potential other opportunities that I just want to comment on is alternative energy. And so if we look at that sector and that space, really gone through a challenging period here where we had a number of wind companies, a lot of heavy capital expenditure businesses under pressure as rates went up, as the attention started to go away from alternative assets to some extent. And now we're going in the other direction again. And look at some of these pensions saying, okay, these are reasonable, good long-term businesses that maybe we can buy at a reasonable multiple. And so that area is starting to shift positive. Rates have come down depending where their funding is as well. That's a positive tailwind. So I think alternative energy is worth considering as well. So cap-weighted S&P 500, and just the crux of this is most major indices around the world are market-weighted. And so as you see a position grow, it gets bigger and bigger and bigger, like NVIDIA has. And so as the market grows, the market cap grows of NVIDIA, and we'll say Microsoft and Amazon. As they grow, they become bigger and bigger, bigger concentrations, where an alternative investment option is called a cap-weighted S&P, and so that's equally weighted. And so, as I mentioned off the top, the number of the S&P companies are attractively priced at these levels, and so they haven't performed extremely well. So, considering if you're very concentrated, presenting some rebalancing towards cap-weighted could present a particular opportunity there. Gold, I think, continues to hold that space as the geopolitical uncertainty of the world continues to get attention. You get the central banks fighting. You get US dollar looks like it'll continue to be something that will play a major role in the world. But you're getting the BRICS countries starting to say, how do we infringe on this? And so continues to be an area that I think provides central banks and others alternative asset to hold in the portfolio, a different currency. Emerging markets and international markets, as I commented off the top, the valuations are quite attractive, and so we'll look at that in the next couple of slides. Value versus growth, I'll comment on that a bit on the slides. Commodities and bonds. So we've talked about those areas for quite some time. So as we just head into the last few slides, sentiment really matters too from a market perspective. And so we get a great gauge internal research that we look at that shows kind of the extreme pessimism and extreme optimism. And so it's rare when you get into that extreme pessimism, and it's rare when you get into the extreme optimism. So oftentimes we're somewhere in this range. But when you're thinking about making decisions, and so when I would look at the market and say, okay, maybe 2, 3 days ago, we had the market down pretty materially. Some of the key companies and sectors were trading pretty negatively. And then this would be a reasonable model to go and say, okay, what's the world thinking about it? And the world's starting to think, okay, maybe we're getting pessimistic. Well, that would be a signal to say, okay, let's buy then. You want to buy the inverse of this. And so as the extreme pessimism kicks in, the better risk reward. On the vice versa, if the extreme optimism, it's a lower risk reward. So great quant model just to think about implementation of an investment strategy. And so as we think about the pricing of markets, and so I started in this business thinking about valuations. And so I read Benjamin Graham and Warren Buffett and all these individuals that thought about valuations and do valuations matter. So I still think PE, price earnings multiple, which is price plus or divided by the earnings, gives you a gauge for where and how the markets are presently trading. And so this was a great look at just the band within which the TSX has traded. And so, as you know, we got huge extension to the upside. We participated in the last tech rally because we had a lot of tech exposure with Nortel and JDS and many of the other names that people are familiar with. And so as we got to extreme valuations, we had a material correction that we went through the 2000s in that space. And then we had a bit more of an extension to the upside again as well in Canada, and then we contracted, and now we're somewhere in the middle of that. So the Canadian market isn't super undervalued, isn't super overvalued, but 14.8 times earnings is quite reasonable. Forward earnings is quite reasonable. And so as you think about what I'd potentially like to own, there's a lot of businesses in Canada that are paying good dividends, trading reasonable valuations. Maybe this is an opportunity to think about where you want to have some exposure there. And then if you look at the TSX versus the S&P, also another place to think about because the S&P has been outperforming Canada for a number of years, and we usually trade quite closely. And so that is something to consider when you think about asset allocation. Again, similar here, large cap versus small cap. Always love this. So these are small businesses versus big businesses. You're starting to see an uptick here now while small cap is starting to outperform. So maybe this is an opportunity to invest in an area where there's some good risk reward at this point. So, and then as we start to look at some of the US markets, I think it's important to think about this as well, where you look at the S&P versus the MSCI World. So MSCI, most people look at an area called EFI, which is Europe, Asia, and the Far East. And that's an ETF that you can buy to get exposure to that space. But that gives you global ex-US when you're thinking about it. And so we've had an extended period of time here where the S&P has outperformed the rest of the world. Will that continue in perpetuity? Potentially, but something to think about when you're thinking about where opportunities are. And then Russell small versus large, again, similar. So the Russell is a better view of the whole US economy / markets. Is the Russell gives you, there's large cap and small cap. Again, US small cap businesses are still $1 billion businesses, so still big businesses. But this is something to think about. We've gone through another extended period of large cap outperforming small, and this continues to trend down. So this is an area of maybe to say, let's keep this on the watch and see if there's opportunities here. And if we look at S&P 500 value versus growth, same, we've had growth outperforming, and it's been quite some time where we've had this extended period of time where growth has outperformed value through this sector. And then as we start to move to the rest of the world, this is where I think it potentially gets more attractive and more interesting from a risk reward as these are the standard deviation bands. And so there are some great slides out there if you want to go look at the standard deviation of the NASDAQ. It's worth thinking about the fact that we're 3 standard deviations above our long-term average. But this is a great one to think about. This is 1 standard deviation away from where it was, which is the red on both sides of this. So this is EFI, so this is Europe, Asia, and the Far East. We're still trading in the lower end of this band. If we look at emerging markets, again, below the medium in that band at 11 times earnings. I mean, these are worth paying attention to. Obviously, the counter to this argument is it's because there's a risk premium associated with it, is what the others would say. So I think it's worth considering. These areas are starting to look a bit more attractive, and we want to think about what and how that could potentially provide some returns by starting to look in the other direction of just being concentrated in one area, one particular sector. So this will be the last one before I wrap it up. And certainly if you have questions, we can come back and can have one-on-ones as we do and give you an update on what's happening and what's going on. But this is the last one I think I'd like to leave with before I summarize. The markets, as I commented on, have been pretty volatile, and I'd say bonds are certainly a major part for what happens from here. And so in the US, the mortgage market's based off of the 30-year bond. And so the 30-year bond in the US has approached the 5% level. And the individuals buying houses in the US, they have to pay off 30 years because they're locking their mortgage for 30 years. And so as this level starts to elevate, which it is now, starts to put downward pressure on the US economy. And so this is a major thing where the governments maybe don't comment outwardly. It's a major part and something to consider around the risk and or opportunity set. And so if we bring that back over here and we look at the changes over the past 12 months, certainly we know this in Canada. So over the 3 months, we've seen almost a 2% drop in the 3 month. And so that's driven off of the view of what the Bank of Canada is going to do. And then down into the US, if we look at, there's been a 1% drop. And then the 2 year, almost a 1%, but US hasn't budged. So we see a pretty material divergence between those two areas. And then if we zip down into some of the foreign markets, Germany, the UK, and Japan, again, pretty material moves to the upside here. So you'd be losing money in that backdrop, thinking about it. And so I think the areas of opportunities continue to be, if you're looking at having some exposure in the bond space, these are something important to think about. This also plays a role what happens to the mortgage market from here. So I'd say the last thing that I would leave you with just before we start to wrap up and have Eva come back on, is just thinking about where the opportunity set is from here. And it's easy to look at what's been working for the last 2 years and maybe even longer than that, depending on what you have. But it's more difficult to look at what's happening ahead of us. And there's no shortage of information in the world, in the markets, in the media, more than I've ever seen in my career. But I think where the opportunities are is thinking and looking around what's around the corner. And my job always has been to take a look at the information, take a look at the research, and then do our best and my best to put you in a position to succeed over the next 12, 24 or 36 months. And we're always doing our best to look around the corner. So digesting what's coming in to the world and the markets, trying to reposition for what we see the opportunity set to look like, and then putting you in a position to succeed. So For the clients that have joined us today, thanks very much for continued support. I continue to do my best to help you succeed and get you to your goals. For any individuals that are listening in for the first time, thanks so much for taking the time to listen, to provide you an update on what happened in the markets and what we see happening ahead. And as always, any questions, certainly feel free to reach out. So Eva, I don't know if you want to jump back on and see if there was any questions that you had that you wanted me to comment on before we wrap.
I mean, Ben, you have loaded us with so much to think about. We don't currently have any questions, but like Ben had said, this video will be up on our YouTube page. Please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. We have weekly roundup where we basically tell you what has happened in the week in the macroeconomic space and in the market space. So please visit us, subscribe, like, comment. We'll be able to answer some of your questions. Thank you once again for listening. Enjoy the rest of your day.
Thanks, everybody. Take care.
Bye.